Hello and thank you for tuning into the MacDesk Floor Report. Today is Thursday, the first day of March, and I'm Rebecca Darst from the MacDesk, breaking down the market action from the floor of the NYSE. Right now we are up about 35 points in the Dow, having wobbled a bit on some disappointing U.S. manufacturing data. The February ISM index fell more than expected, down to an almost neutral reading of 52.4 for the month of February against 54.1 in January. Analysts had been broadly expecting a reading of 58, so that was a big miss, and contrasted very sharply with some bullish manufacturing data released overnight from China. Data there representing a third straight month of PMI gains, so some east-west divergence going on today. Otherwise, we've been riding a wave of good feeling this morning after bullish weekly U.S. jobs data and some very impressive February comps from leading retailers. A word about those retailers. February tends to be a swing month in terms of same-store sales, and while this year showed a second straight month of unseasonably warm weather, these higher temperatures worked against retailers in January, who were still trying to move heavily discounted winter items at the time. But in February, with spring merchandise on the shelves, warmer temps portended something very different. So who benefited? Take a look at the gap. The stock is up better than 8% this morning, delivering a 4% increase in same-store sales, where analysts were looking for a slight decline. The options market had an inside track on that February sales beat. Ticker GPS was looking rangy around the 23.50 level yesterday, but right off the open, we noticed heavy demand for March $25 calls. Customers were buying these for around 15 cents yesterday. This morning, they're in the money and trading for more than $1. So if you bought those gap calls yesterday, you may suddenly find yourself in the luxury demographic today. Before this raft of U.S. data, futures had been looking slightly positive on follow-through from Europe. This followed a ruling from ISDA, the International Swaps and Derivatives Association, which ruled that Greek credit default swaps will not be triggered for now, even as Greece signals that it may restructure its debt. So that's bad news if you tried to insure holdings on Greek sovereign debt through credit default swaps. Good news if you were selling those credit default swaps. But this sent the euro to a session low against the U.S. dollar. Now, some of the ambivalent action we've been seeing in the euro-dollar cross today may also be carryover from the release of data early yesterday on the ECB's second round of long-term refinancing, the LTRO. That data showed that some 800 institutions borrowed more than 500 billion euros during that second operation, which was generally regarded as a high take-up. While that number was bullish for Southern European bank stocks, this region represented nearly half of the money given out during the first LTRO. It's unclear what this is going to mean in terms of risk assets in Europe in the longer term, and some analysts feel that the effect will be net bearish on the European currency. We also had some somewhat dour comments on the challenges facing Europe from Fed Chairman Ben Bernanke speaking on Capitol Hill yesterday, with the chairman also hinting that continued accommodative monetary policy here on these shores may not be needed if U.S. economic data continues to be promising. His testimony, by the way, continues today. VIX, meanwhile, is down around 4% this morning at 1773, and we're seeing some unwinds of weekly SPY positions in the options market. Very nimble trading in the ETF options so far today. For additional market insights, be sure to check your inbox at 1 p.m. for the midday. For now, that's it from me, Rebecca Darst, for the MacDesk Floor Report.